Are you looking for a smart financial move that can provide you with a low interest loan option that can consolidate high interest debt and also increase your net worth? Imagine borrowing money from yourself instead of relying on external lenders. In today's video, we'll explore the concept of taking a loan from your 401k, and I'll show you how to be your own bank. Stay tuned to learn the ins and outs of borrowing from your retirement savings account and how it could benefit your financial future. I once used my 401k to pay off debt. Due to various reasons, I had accumulated $50,000 in credit card debt. Most of it was in 0% interest promotional credit card balances. However, my credit score was negatively impacted due to the high ratio of debt to available credit, and the promotional periods were about to end. At that point, my interest rate would have risen to 22%. Instead of paying that high interest rate, I took a loan from my 401k and planned to pay off the balance over the next 5 years. By using my 401k loan to pay off the balances, I increased my net worth and saved myself, get this, $69,252. If you're new here, I'm Justin Saffel. I'm a financial advisor with more than 15 years experience in the financial markets. Whether you're just starting out in the world of personal finance or looking to take your investment knowledge to the next level, you've come to the right place. On this channel, we don't just talk about numbers and market trends, we also infuse wisdom, self-improvement, and sprinkle a little bit of spirituality into our financial decisions. It's about aligning your financial goals with a meaningful, purpose-driven life. Our mission is to help you become financially independent, and we're here to learn and grow together. Let's get into it. Let's start with the 401k lending basics. Borrowing from your 401k is a process where you take a loan from your retirement savings account. This loan, which you're required to pay back with interest over a predetermined period, can provide a low interest option if managed correctly. It's like being your own bank. There are some pros and cons of 401k loans though. There are several advantages to 401k loans. You can quickly access your cash, borrow up to 50% of your 401k value, and enjoy lower interest rates compared to other loans. The interest you pay goes back into your bank account, and the fees for managing the loans are pretty reasonable. On the downside, you could face penalties if the loan isn't repaid on time, and leaving or losing your job may require you to pay back the loan sooner than expected. So how do 401k loans work, and what are their tax implications? When you take a loan from your 401k, you're borrowing money from yourself. The borrowed amount is subtracted from your 401k balance until it's fully repaid. You repay the loan with interest through automatic deductions from your paycheck. The interest you pay goes back into your 401k account, contributing to your retirement savings. It's important to note that a 401k loan is not considered taxable income if you follow IRS rules. However, failure to repay the loan according to the terms can result in tax implications. Okay, now when should you absolutely consider borrowing from your 401k? There are specific situations where borrowing from your 401k can be advantageous. First, if you have high interest consumer debt like credit cards, a 401k loan can help you consolidate your debt at a lower interest rate. Additionally, in emergencies like unexpected medical bills or major home repairs, a 401k loan can provide immediate funds without resorting to high interest debt. Before deciding to borrow from your 401k, it's crucial to have a well thought out plan. Understand the amount you need, the repayment schedule, and how it fits into your overall financial plan. Consider the potential impact on your retirement savings and explore other less risky options if available. Borrowing from your 401k shouldn't be taken lightly as it affects your future savings. I told you about my personal experience, so let me show you the math with a high-interest consumer debt example. Okay, let's consider scenario one. Jim has a $10,000 credit card debt and $50,000 in his 401k. He could either make a payment on his credit card until it's paid off, or he can take a loan from his 401k. Which option should he choose? Let's assume that Jim decides to pay off the credit card over time instead of taking a loan from his 401k. Here's a yearly breakdown of Jim's 401k if he keeps the $50,000 invested in an index fund that yields about a 7% annual return, which is pretty achievable for most 401k portfolios. After 5 years, Jim will have $70,881.26. But what about his credit card? How will that pan out? Let's assume a 22% interest rate on a $10,000 credit card balance, which is pretty typical for most credit cards. Let's also assume that Jim has $210.02 each month to pay off his debt, which just so happens to be the same amount he would have to pay on his 401k loan to have an apples-to-apples comparison. Here are the credit card payoff calculation results. So, first of all, it would take Jim 114 months or 9.5 years to pay off his credit card. He will have paid $13,844.59 and a total of $23,844.59. So how is Jim's net worth doing after all this? With his $50K invested in his 401k, he now has $70,881.26. But since he's had to pay so much interest to his credit card companies, we have to subtract the interest paid. So Jim's net worth, after it's all said and done, is $56,996.67. Let's contrast that outcome with the option of Jim taking a loan from his 401k to pay off the credit card while paying himself interest on the loan. If Jim takes the $10,000 loan to pay off the credit card, that would leave him with $40,000 in his 401k invested in an index fund at a 7% annual return, which is very achievable for most portfolios. To pay off his loan in 5 years, Jim would need to make a $210.02 monthly principal and interest payment to himself. Let's look at the yearly breakdown for Jim's 401k investment if Jim starts with the $40K and invests the $210 payments from his loan. At the end of 5 years, Jim will have $71,740.95. Okay, now that we've worked through both scenarios, let's see which one is better. In scenario 1, where Jim decided not to take a loan, his net worth after 5 years is $56,996.67. In scenario 2, where Jim decides to take the loan from his 401k, his net worth after 5 years is $71,740.95. That's a difference of $14,744.28. So you see, in this case, you should absolutely borrow from your 401k to pay off the high interest consumer debt. While 401k loans can be useful in certain situations, it's important to consider some alternatives as well. Building an emergency fund can provide a safety net for unexpected expenses, reducing the need for loans. Low interest loans from credit unions or online lenders can also be a viable option, as well as a home equity loan or line of credit if you have a substantial equity in your home. Okay, let's say you find yourself in a situation where you have high interest consumer debt, such as credit card debt, and you're looking for a way to consolidate it and save on your interest payments. Borrowing from your 401k can be a pretty smart move in this scenario. Here's a step-by-step guide on how to borrow from your 401k. The first thing you want to do is understand the loan terms. Before proceeding, familiarize yourself with the loan terms and conditions of your 401k loan. This includes interest rate, repayment schedule, and any fees associated with the loan. The next thing you want to do is determine the loan amount. Calculate the amount you need to borrow to pay off your high interest debt. Remember, you can typically borrow up to 50% of your 401k value to a maximum of $50,000. The third thing you're going to do is contact your plan administrator. Reach out to your plan administrator to initiate the loan request process. They will provide you with the necessary paperwork and guide you through the steps. The fourth thing you're going to do is complete the loan application. Fill out the loan application accurately and provide all the required documentation. The fifth thing you're going to do is review and sign the loan agreement. Carefully review the loan agreement, ensuring that you understand both the terms and conditions, including the repayment schedule. Sign the agreement once you're confident in your understanding, and then begin repaying the loan. Once the loan is approved, the payment process begins. The loan amount plus interest will be deducted from your paycheck automatically. This ensures a convenient and hassle-free repayment experience. It's important to note that borrowing from your 401k should be a well thought out decision. Consider the impact it may have on your retirement savings and weigh it against other potential alternatives. Additionally, consulting with a financial advisor can provide you with some valuable insights tailored to your specific situation. Remember, the goal is to consolidate your high interest debt and save on interest payments. With careful planning and a responsible financial management, borrowing from your 401k can be a viable solution to achieve financial freedom and peace of mind. If you've enjoyed this video, then consider watching one of my other videos, and remember, I provide the advice, but you have to make the choice. Stay creative, my friends.